All right, traders. What's going on? How are you guys doing? Guys, is there an echo here? Okay, there it is. I think it's off now. Hey, look at that. Look at that IBM guy. Full or what? You see that? You see how beautiful that is? Whew. That is amazing. You kick off the day, right? Look at this. You kick off the day with one of the most, one of the juiciest, one of the most appetizing, one of the most reliable events that you know. You kick off the day with a clearing elephant bar from a narrow state right off the 200. How many things is lined up there? So look, let's go over it. You got narrow state, narrow state. The moving averages are close. The price, the moving averages are all close. Number two, you have an elephant bar clearing that's originating off the 200. Wow. Then, boom, there's your ad on the first GBI. Now, this is a little tricky because there's a time stop possibility there where you kind of get out and say, look, this is not doing what it's supposed to do. So I'm okay with a trader saying, you know what, I'm out. But wow, here you have it again. Now let's go over this one. You have elephant bar plus clearing originating off the 20 in this case. See, this one is originating off the 200 and the 20. This is originating off the 20. That's fine. Wow. And once again, you get your first GBI. Boom. That is truly beautiful. This is in this is worthy of being a non-fungible token, right? That's classic there. Let's not forget you throw that 8-period moving average on that thing, man. Whew, that's beautiful. Yeah, that's right. Bang that thing like wang, man. Ah, no, no, I did not play that actually. I was with the mentorship group, and Philip brought this up to us, but that's right, to the land of profitability. Well, guys, okay. So, guys, welcome to another study session. This is a Kickstart study session. It is your Holiday Friday, as I was mentioning to my former groups today, Black Team Mentorship Group. We are in an extended weekend this weekend, so there's no trading on Monday. I just want everybody to know that. All right. Sunday is what Americans call Independence Day, 4th of July, what Great Britain calls Treason Day. Treason Day, it depends on your perspective, right? But what normally happens, yeah, what normally happens mm, uh, is on a Friday in the summer, markets tend to go flabby, if you will, flattish, not in a non-committal state, a lot more after the first 30 minutes or so. So you get these pops potentially in the morning, but then things kind of go flat, especially in the summertime on a Friday. Traders come in the morning, they place a few trades, make a few commitments, and then they're out for an extended weekend. And so what happens on a Friday in the summer is that um, a lot of your traders in New York, this was historically most of the trading happened from New York in the past, not necessarily now, but in the past, this was more prevalent actually. But the majority of your traders were from New York, Wall Street, right? And most of them that were good, right, would have weekend places up in the Hamptons somewhere or Rhode Island or, whatever. And they would cut out early on Friday to spend the weekend with their families up in the Hamptons or Rhode Island or something like that, right? And so they would come in the morning early on Friday, place their trades, so place a few trades, place their commitments, boom, out after the first 30 minutes, 40 minutes, boom, they're off to their vacation homes. And so the summertime began to be called the mid-year doldrums, just like we have a midday doldrums, there's the mid-year doldrums, right? And so it's not that every trader would leave, but the ones that had vacation homes would leave. And so which are the ones with vacation homes? The little ones or the big ones? The big ones, right? So the big money would leave, right? And so your market would go flatter because the smaller players who would stay would not have the capability of moving things as much. And that's what would create the mid-year doldrums, so that on a Friday after the open, not in every stock, but in a large portion of the stocks, you would tend to see. Now, it's less of the case today, but it's still there in a way. It's still there. Even some of you might see yourselves like, Friday, I'm heading out, man. I'm not going to trade as long as I normally do, like on a Monday or Tuesday or something like that. Even you do it. So still you have the effect. It's not as stark as it used to be, but it's still there. So I want you to be aware of that. Now, when you have a 4-day weekend, it's more pronounced. All right. So IBM is odd in this respect because you normally don't get, this is more of a news driven thing, I'm assuming, but you normally won't get that kind of flow that late in the morning on a holiday weekend. All right. You tend to get this. See, look at Nvidia. That's holiday weekend trading, non-committed. All right. Nobody wants to go over the weekend, an extended weekend, with the possibility of some big mouth politician saying the wrong thing that shakes financial markets for Tuesday's opening, or some event in the world that rocks things in the markets start off Tuesday morning. It's just people would rather go home in peace and not have to worry about that, the big players at least. Now, if we take that mid-year doldrum and we bring it to the micro, just like there's the macro weekly or monthly chart and then the micro 2-minute chart. So this concept is macro from the year point of view. In the middle of the year, you get this Friday doldrum type activity. But we get that doldrum like activity every day in the middle of the day. All right. So what creates that in the middle of the day, like after 11:15, 11:30, things can kind of get non-committal up until about 2:15, 2:30. So let's call it 11:30 to 2:30. All right. 11:30 starts it and 2:30 ends it completely. All right. And so this would become your midday doldrum period every day. That's the micro version of the markets kind of going flattish every day, being non-committal. Your signals kind of lose a little bit of their edge, not all of it, but it loses some of it in this period. Now, why is this? Well, it's simple. It's called lunch. Now, remember, we're talking about a time when the vast majority of trading came out of New York. And so this is the period where traders would begin breaking out of their offices to go grab lunch. But there were traders that would bring their lunch from home with them into the office, and they would stay at their desks. Brown paper bags with, uh, peanut butter and jelly sandwiches, ham and cheese sandwiches, or they'd bring like a hero sandwich in from the deli down the street so that they would stay at their desks. Now, I ask you this, all right? Which traders had the peanut butter and jelly sandwiches at their desk? And which traders would go out to nice restaurants for lunch? You see what I'm saying? So this is why you had not necessarily losers, because you can't be a loser very long on Wall Street. That's just not allowed, right? And you lose your job very quickly. But not losers, but smaller. And so you had this midday drop off in volume and activity because the big players would actually place their smaller players in charge of their positions and say, look, call me if anything dramatic happens. Don't do anything, just watch. I'll be back in a couple of hours, right? And so the traders that were left behind had very small responsibilities, had very small, they were not able to step on the gas, if you will. They were not able to put big money in or pull big money out. Their job was to maintain. And so the market would kind of go flattish. And then if you start to see around 2:15 or so, boom, things start to pick up because the big guys were back from lunch. And so while today you have less of that effect because trading has become more democratized around the world through technology, the internet, direct access trading from your computers, not necessarily from an office. This has lessened the effect because it's not lunchtime in the middle of the day in Japan. at 11:30, 2:30 New York time. So, you have less of the effect, but the cycle, these cycles tend to stay longer than they should. And so just because it used to be, people still play it like it still is. And so it's become sort of a self-fulfilling prophecy in a way. Tavern on the Green, Vincent. Guys, I held my Vincent's talking about a restaurant, Tavern on the Green in Central Park, New York. I had my first book signing in Tavern on the Green. I used to do quite a bit at Tavern on the Green, actually. Um, yeah. Yeah, I used to have one of the industry's biggest Christmas parties in Tavern on the Green, and it was, if you got a ticket to my Christmas party at Tavern on the Green, you were very special in the industry. So people would vie for a ticket to my traders Christmas parties on Tavern on the Green. It was crazy. Those were the years, 1990s. Cool. All right. I'll post some of those pictures. I'll do that. I'll post some of those pictures from Tavern on the Green, some from some of the parties. Yeah. Um. All right. So that's, it's those are interesting things to know, guys. So what am I saying here? You have you can look at the market's day into three components, right? You can really look at them into four components. So let's do the four components. You've got the open, okay? You've got after the open, and this is 9:30 my time, Eastern time, to let's call it 11:30. Right? And part one, part two. Then you have the midday doldrum period. That's lunch. Okay. That's 2:30. It's part three. And then you have the close. Now, I don't know if you know the history of this, but the market used to close midday. So people would all walk down to Wall Street with their top hats. I've told you the story before, right? You know, and trade on this small street called Wall Street. And it was only a few hours, right up until usually lunchtime, and then boom, the trading was over. And in these top hats were the commercial paper slips or the trading slips. And so you would put your trading slips and your commercial trader trading slips, trading paper in your hat. And so if a person had a top hat like this, they were okay, right? You could do business with that guy, but you probably want to do business with the guy with the top hat like that. And so the taller your hat, the richer you were. So these guys would come in on the street and just wait for people to trade with them, right? The biggest hats got the most business, the smaller hats got some business, but the smaller hats could over time grow through trustworthy activity, whatever. And these were your first brokers, right? And so these guys would then go to lunch and then the trading would stop. So the top hats are having lunch. It's over, and they wouldn't come back. But as businesses begin to grow, whatever, it demanded trading more. All right, I'll give you more money here. Da, 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 da. And so they would start to come back after lunch until it would go to 3 p.m. So it started from 10 to 11. Then it went from 9:30 to 11. Then it went from 9:30 to 11 or so, then lunch, and then come back until 3. Then it went to 3:30, and then the markets got extended to 4. And this is the history of the times of trading, how it grew to be larger and larger. And so new markets today are how long? Because this is still antiquated at 4. Stopping the market at 4 and starting it back in the morning is still old now. That's old. It's 24/7 now. So all new markets, like the futures market, is newer than the equity and bond market. So the forex market is newer than the equity and bond. So the forex market is 24 hours a day, 5 days a week. But that's still old too, because there's the weekend where it stops. Now any new market after that is 24/7. And so just like trading only 1 hour, 10 to 11 was old, 9:30 to 11 is less old. All right, coming back after lunch to 3 is less old, then to 3:30 is less old, then to 4 is less old, then all the way to 24 hours, 5 days a week, less old. Now 24 hours a day, 7 days a week is the current, right? So it's important to understand these 4 parts, guys, and where your odds are. Now, let's break this down a little further. I do a lot of teaching about my specialty, which is here. That's my specialty right there. That first 20 to 30 minutes. That's what I became known for. That's what I became semi popular and famous for on Wall Street. It's the skill that made me feel like I could go out on my own because everyone wanted to know how I did this. And this is where I shine the most in terms of short-term trading. Um, but this may not be where you shine. It's something where you should try to shine, but you might come to the conclusion after a while, I just don't do well there. I do better here. And your stats will reveal this. You should know what time of day you tend to do your best trading. If you trade in 4 and or 3, what are your stats in these periods? Where do you consistently do the worst trades, and where and when do you consistently do more of your better trades? When you have your worst days, is it in 1 that's the culprit, or is it in 3 that's the culprit? You understand what I'm saying? Like, you should know this. You got to know the various parts of each day. And if you're not living in the Northeast, you've got to equate these times to your times of the market. So it's very simple. First 1 and 2, first 90 minutes. It's very easy to think about this, guys, right? No matter what time frame you're in. This is 90 minutes, 90 minutes, and then the middle. That's all this is. Your first 90 minutes and your last 90 minutes. Now, the first 90 minutes is divided into two parts, the open and the rest of the morning. That open is 20 to 30 minutes. It's not always the same. Your open can end in 20 minutes. Your open can end in 30, 35 minutes. It's different, but on each day. So it's when the vast majority of elephants have occurred. I mean, whales, I'm sorry, have occurred. So when a whale has, sometimes it takes 30 minutes for a whale to complete on most of your plays. Sometimes the whales complete in 20 minutes. So when do you see a variety of whales that have already completed? You're open for the day is over. You guys understand that? Does that make sense? When you start to see whales, oh, a whale was completed on this, a whale was completed on that, your open's over, right? So, but that time is not the same every day. Sometimes your whales are longer and your open might end in 40 minutes. Sometimes it's shorter. It might end in 18 minutes, where you see a lot of whales complete in 18 minutes. So the stage one and twos, they are not the same every day. Sometimes the one is little and the two is big. Sometimes the one is bigger and the two is smaller. But the first 90 minutes combines both of them. Now, I'm always telling traders, specialize on the bookends. This is what I call the bookends, right? So number 3 is where your books are. What holds the books together are the first 90 minutes. That's one bookend. And the last 90 minutes, that's the other bookend. Specialize in your bookends. All right. And you don't have to trade both of them. Pick one. All right. You can become a late 90. You can become the final 90-minute specialist. You can become the first 90-minute specialist. You can just become an open specialist and be a part of the first 90-minute. That can be your whole career. Or you can trade all day. That's up to you too. If you get good at managing the 3, which is a little more troublesome than the other parts, but still you can learn how to manage that. All right. So Narendra is saying usually between 11:30 and 2:30 p.m. That's when she has her worst trades. That's when most people have their worst trades. So I tell traders, drop 3. Find something to do. Give yourself a break. Guys, listen to this carefully. It is proven, right, that you only have about, you've got 4, let's say you've got 4 to 6 really high quality decisions. That's all you have. After you go beyond 6, let's say, the quality of your decision making starts to break down, and rapidly so. That no matter who you are, how bright, how intelligent you are, that you've only got the capacity to make between 4 and 6 very high quality, the purest of all decisions, your first 6. After that, 7, you lose quality. 8 more, 9 more. By the time you're at the 20th decision, your quality, the quality of your decisions are just crappy, stinky. And so, what if this were true in your trading as well? What if you knew that my first 6 decisions are statistically my best? I've got to make these count. I've got to take them with care. So now you've got these pockets of the market. Where are you going to spend your six? In the three, where the odds are lower than the other parts? I'd say no. Now you'd have to decide if you're going to deal with the first 90 minutes, where are you the better? Where are you better at? Are you better right off the open? In which case you want the majority of your six at one. But what if you're terrible at the open? Then you want the majority of your six after one. Does this make sense? All right. Yeah. So it's always this is an interesting game, guys. Life's an interesting game, right? I think that the interesting part is just putting it all together, figuring it all out. We all want to reach that finish line, but that's not where the joy is really. You realize that if you achieve one of those horizons that you're after, you realize that the joy was in getting there really. If someone airdropped you at the finish line, it's just you think that that would be great, but it's devoid of the sheer ecstasy of having gone through the work and figuring it out, falling and coming back, and there's a pride and a deep joy in that sense of completeness, wholeness. You know? Hmm. Chauncey's asking, why are you better at the open, Oliver? Any particular noticeable skill that makes you better at the open? Um, no, it's a good question. I never really thought about it. Never thought about it. I just say that I've tended to know what's true really fast. And I've had that ability, I believe, from very early in my life to just a sense of this is real, that's not real. That's true, that's not true. But very quickly, without a very thorough analysis. And I was always usually right. I remember um, very young asking my third grade teacher, who was in third grade, um, I asked my teacher, isn't what you call intelligence just memory? Well, I didn't use the word intelligence. I remember using the word smart. I said, isn't what you call smart just memorization, memorizing? And I remember the teacher being thrown by my question. I saw it in her face. But she came back because the teacher has to be a teacher to come back with something, right? And she says, well, you have to be smart to be able to remember. And I instantly knew that was wrong. I was in third grade. I just knew that that answer is wrong. I didn't have to think about it. I didn't accept it. I didn't take it and say wonder about it. I just instantly, instinctively knew that response is wrong. Memorization is not intelligence. Um, and so that's just an example of just always having that quick. And I think that's why I can in an instant say, okay, That has this odds, that should follow through like this, that should da, 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 da. Boom. And I don't need a lot of time. Now, that's a lot more difficult for a person putting things together. And so I will tell you that I didn't start off having that, but because that's more of my nature, when I did start to put statistics together, like clearing bars have X number follow through percentage, um, like that, then I just knew I just grab it and quick, and I was always able to act very quickly. The other thing is that, guys, I went the other way. You see, when I first started trading, it was a sacrilege to trade in the first 15 minutes. So no traders, I mean none, traded before the first 15 minutes. It was just an unwritten rule. You don't trade the first 15 minutes. That's when the view was the novices orders are going through on the first 15 minutes. Let those go through and then go the other way. That was the general consensus, because the novices called up their brokers before work. They would place their orders with their brokers before work, before the market opened, to say, okay, buy IBM this morning, feeling smart, you know. And they'd go into the office and tell their friends, yeah, I called up my broker this morning, and we're doing a little bit of IBM this morning. What are you doing, Jim? You know, and so the Wall Street guys would laugh at those guys and be like, all right, so these guys are buying IBM this morning. We can see how it's ticking up. Once this flurry is over in the first 15 minutes or so, all the brokers' orders are done. Let's slam this thing, you know? And so it was this unwritten rule that you let the market show you where the novices are playing, and then you go the other way. You need 15 minutes to do that. So I was doing that in the beginning. And I realized, like, well, why am I missing all of these novice driven moves? I don't care who's making it move. They're moving and we're just sipping coffee. Like, what if I'm able to grab the move, the initial novice driven move, and go the other way? And so I began trying it. And I remember all the naysayers. You're going to get slammed. You're playing with the novices. And and then that choir of naysaying got smaller and smaller as my profits got bigger and bigger. And then it was like, can you talk to us about what you're doing here, Oliver? This is amazing. And then, traders back in the day operated in groups, and then other groups began to ask me, can I come talk to their group of traders? And then other firms, word got out, would start to ask, can I come to their firm after the market and talk to their traders? And it's that made me realize, you know what? I should branch out on my own. And that's what led me to leave Wall Street and create my own off Wall Street firm, right? So it's funny. But anyway, yeah, that's the story of me becoming a trade the open kind of trader. And I was revolutionary in that regard. You see, this is why charting, guys, here's something interesting as well. This is why charting for me began on the 15-minute chart. Why is that? Why did charting start with the 15-minute chart? Because you don't do anything for the first bar. If I didn't do anything for the first 15 minutes, then you want to see how the first 15 minutes form. So you watch the 15-minute chart. Now take your play. Boom. That's clear. Now, I've always said, and some of you new traders may not have been here may not have heard me say this because you haven't been here long enough, but if I if I wanted you to make the most money without becoming the most skilled, I would start you trading on the 15-minute chart. All right, let me repeat that. And I know this is going to intrigue some of you who haven't heard this before, but if I wanted you right now, if I wasn't interested in you becoming as skillful, and I was only interested in you making money right now, you would be trading the 15-minute chart, not the 2-minute, not even the 5. So what am I saying? You right now, you can increase the money you make right now without another effort, without more work. You can start making a lot more money right now without any extra work if you go to the 15-minute chart. But you will never, it'll take you years and years and years longer to become as skillful as I would like you to be. So there's a trade-off between becoming skillful, which will ensure that you stay in this game for life because it's coming from skill more than making money right now. Right. So uh Tesla today. Yeah. So you are going to deal, well, so here's the first 15-minute, but there's no play here, right? Because if you're going to play after the first 15-minute bar, unless you buy into that bar, but if you're going to play after, like we would let the first 15-minute bar go by and either go the other way or by the pullback, right? Sometimes if the 15-minute got too much, you would go the other way with it because that's, the guy saying, yeah, my broker, I called up my broker this morning and we bought some Tesla. What did you and your broker do, Jim? And if they did that too much, the traders would come in and just slam the market the other way, try to shake them out. You know? Um, so so it again, the 15-minute can make you more profitable right now. And I'm not even saying that you can't even take some plays on the 15-minute if you want. That's fine. But I would not abandon the 2-minute because the 2-minute is the best training time frame out there. Because you will do exponentially more trades, which is what is required to become skillful, experience. And on a 15-minute chart, you'll do one trade a day. Sometimes you may not even find a play. Right? So your experience will slow down to a crawl. Do I use the 15-minute for long plays too? What do you mean long plays, Clifford? Long as in not short? Gotta watch the terminology here. Same techniques, Menji. Oh yeah, if you see something powerful on the 15-minute, yeah, I mean, but you see, guys, I'm at that state where the 15 and the 5 and the 2 are not really different. I mean, it's the same data. You're just looking at it grouped together differently, yes? Are the trades any different on a 15 than on a 2? Are they any different? Are the buys and sells different? No. So what's different? The way you are seeing them grouped together, right? So you can reach a certain level where it doesn't matter what time frame you're looking at, you see the same data. So I see the 15-minute in the 2-minute. I don't need to really look at it, right? All right. So, can you use the 15 for overnight? I would tend to use more of a bigger time frame for overnight if I were playing. Like the 60-minute is a nice, can be an okay overnight if you're swing trading or something like that. Well, that's the whole point, and you trade more on the 15, on the 2-minute than the 15, so therefore you become more experienced, right? And so what is required to become skillful? Experience. So that's why you are encouraged to do most of your trades on the 2. But your money will be bigger on the 15. You do understand that, right? So if we look at that, let's take the IBM as an example. So let's go to the 2-minute. And some people might get hiccuped out of the play, although you shouldn't. But some people might get hiccuped out of the play here because they start, this is a big gain, and they start going bar by bar and they're out here, right? Whereas that if you go to the 15-minute, you don't get hiccuped out of it, which was here. I believe you got hiccuped out there on the 2-minute. Well, let's go back. I'm curious now. Where's your hiccup? It is here. And you don't even see that hiccup on the 15-minute. So you don't even see that hiccup there. It's not even visible on the 15-minute. You follow what I'm saying? So if you applied the bar by bar on the 2-minute, you're out. If you applied the bar by bar on the 15-minute, you're not out. Right? So your money's going to be bigger on the 15-minute overall, but your experience is going to grow faster on the 2-minute. All right. And the method is the same. There is absolutely nothing different. It's just watching your same movie in slow motion. In slow motion. You know what I mean? So 2 is regular speed. 5 is like a little slower. And 15 minutes is really slow. 1 minute is like watching YouTube videos at 1.5 times speed, right? Tick chart's watching it like at 5 times speed. Uh, t- 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 yeah, that's right, Pradip. That's true. After um, trading for a while, the 2-minute, it becomes really painfully slow on the bigger time frames. Yeah, but it can be a nice change every now and then as well. So sometimes, guys, you can also get too close to the trees for too long of a time that you start to lose sight of the bigger picture, the entire forest. And so these are traders that you can see that when they were they were getting 60 cents trades, sometimes every now and then a dollar, maybe even a dollar and a half on a trade. And now they're grabbing 20 cents and they're happy. That's a trader who's gotten too close to the trees and they have lost sight that they're in a very big forest, right? And so if you have found that you feel like nothing moves more than 20 cents, so you have to take it, that's the sign that you're there. You've been trapped by being too close to the trees, and maybe stepping back to a bigger time frame for a period of time will help you. Does that mean that when we become experienced enough, we should move to bigger time frames? Well, yes, because look, guys, the I have 90 right now. I've got 98% of my wealth in bigger time frames, right? And so 2% more or less I trade with. So in the beginning, this was all all of it was trading, trading. As I began to become profitable beyond my needs, all right, I would grow this part. And so if I made, let's say, if I made 100, that can be 100,000 or $100. It doesn't matter. It's just the concept. If I made 100 and I only needed 20, so if I made 100,000 and only needed 20,000 to live, I would take the 80,000 and start deploying it there. But I started out with trading. I didn't start out trying to make bigger gains first. I'm very glad I grew that way. To me, it's the natural way to grow, because if I teach you something on the 2 minute and then you go to the 15, isn't it easier? Do you see that? Do you see that it's easier, right? It's simpler, more obvious, cleaner. Yes. But if I were to teach you on the 15 and then take you to the 2, it would be harder. You understand? So to grow from the 2 upward is better, because you're going to find when you then go to the bigger time frames, the really bigger time frames, and you're playing big money, that you see things clearer than other people. Let me give you an example. Give me a minute here. I'm going to take the chart off. Let me show you something. Let me show you something. All right. Stay with me for a minute. Stay with me for a minute. Okay. Give me a minute. Almost there, guys. Almost there. Okay. You're going to find this interesting, I think. I believe so. All right, guys. So remember, I was telling you that you're going to find that if I teach you something on the 2 minute, these concepts on the 2 minute, and then I say go to a bigger time frame, you're going to find it easier and you're going to find it clearer. And what's going to happen is that in a world where people don't see clearly like you're when a world who hasn't been taught this, you're going to be able to go into that world where everyone's getting it confused and wrong because they don't have this foundation under them, and you're going to see it differently in a bigger time frame. So someone wanted to ask me a question regarding Bitcoin. What is everyone saying about Bitcoin right now? That it's over, right? Bear market. Isn't everybody saying bear market and stuff, right? Again, right? But if I take you with the concepts I've taught you and take you to the bigger time frame, this is what you tell me what you see. I'm curious. You tell me what you see. I'm going to put it up now and I'll show you this. Now you tell me what you see. What do you see? You see a bear market? Is that even close to a bear market? Do you understand? No. So you've got to, this is what I'm saying. Like when these people did not start off learning how to play small, like on a 2 minute, they're even professionals and they get it wrong all the time because they did not have, like I'm glad I grew from the small to the big and didn't just start my career at the big, because it's hard to be involved every day, and it's easier to get confused because you're involved every day, but you, without the foundation of having grown from the bottom up like that. All right. And so the problem that people have with this asset is that they focus on these moves, but they ignore these moves. Which moves are bigger, right? The up moves are bigger. So Bitcoin doesn't crash downward, it crashes upward. It pauses downward, right? So, but why is it that people focus more here? Because fear is more powerful than greed, right? And so greed is quickly forgotten and fear becomes the number one thing. But this is nothing. This was the worst period. But what do I teach you about this? When you look at this, what is this? Isn't this really the first major pullback? It stays in the upper half, right? Yes. And what is this called? The what? What is that called? What do I teach you that is? The double dip and now the new high, right? Isn't it the same? You see it clearly now, right? Now you can go out, get a job at one of these big giant firms where they're all getting it wrong. I'm telling you, they're almost all getting it, not all, but a lot of them are getting it wrong, and bring clarity back to their lives. Right? Do I use Elliott waves? No, not really. I mean, there are some concepts within the Elliott wave theory that I like. It's not necessarily something I use or whatever, but so um, my point is that when you guys can see this clearly on the bigger time frame now because you've seen it thousands of times on a 2 minute. But people who are here in this time frame, they started at this time frame. They haven't had thousands. How do you get thousands of these experiences on this big time frame? This is one play for us in a day. Think about this. From 2015 to 2021, that's 6 years for one play. This is whale complete. Up, double dip, whale complete. That is one play in 6 years. How do you become experienced seeing a whale complete every 6 years? You're getting what I'm saying? How the 2 minutes gonna get you there faster? Gonna get you seeing better than these guys faster because they start with the big, right? Do I think that they're pretending? Some are pretending to get it wrong. Absolutely. Some it's very obvious that they're pretending because when you watch what they do versus what they say, it's completely different, right? So that's when it's just blatant. But a lot don't. A lot really believe that we're in trouble. Now, there is still there's a possibility that we break down. I mean, it doesn't look like it. It looks like this is getting ready to explode to a new high and in the next month or two, right? Which would work perfectly well with Bitcoin cycle where it's a late year runner. It's an early year popper, but a late year runner, and the late year run is bigger than the early year run. So that's its history, right? So it's setting up for its late year run. So that's what I see so far developing, but I'd say 80% of the world's freaking out. But I'm not freaking out. And a lot of people in my Bitcoin trading club are not my traders. Some are, but the ones that aren't my traders are freaking out the most, of course. And they're with me. So imagine the people not with me. So anyway, my main point was that you're doing the right thing. You can make more money right now just exclusively trading the 15 minute. But you will do that at the expense of being able to see things like this clearly on every time frame. It's hard to go from the big to the small too. And so I grew from being an income producer to a wealth producer. A lot of people come into the game and they're just placed right out of college or university into the wealth game. And so they can't or don't understand the short-term game. But you can't translate the big game to the smaller game. It's very, very hard. And but you can, if you get the small game, you can transfer the skill you develop in the small game to the big game. I just showed you. Here's your buy on the pullback. Here's your bottoming tail buy, bull 180 off the major moving average. Here's your RBI buy. All right, you want to take profits and not hold through all the swings. There's your 5 bars up. 1, 2, 3, 4, 5 profit take far away. I mean, you know this. You see, but you know this because the 2 minute allowed you to see it a zillion times, to experience it a zillion times. Right. So I just wanted to show you that. Guys, give me a second again. All right, guys. So cool. Now, I was actually explaining something in the mentorship group, and I wanted to share that here. I wanted to I was talking about how um, I'm like with that group, I'm starting to see some really incredible trading, uh, and it's becoming just more and more consistent amongst the group, right? So let me share one with you. Costa, what was your trade again? What play was that on? I forget. Is Costa here? Fubo. Okay. So this is. Let me show you how. Uh, Costa played this play today. All right. So Costa goes short here. No higher. Goes short here. Boom. 4 lots. Why? Tight, narrow, Fab 4 coming off the 200, low risk play in the trap zone, but it's tight. So Costa knows that if we break through, if the 200 does prove to be resistance and starts a move down, we we come out of a narrow state, which has greater odds of flowing. So he goes short, a little higher than this actually. He goes short on the break of you see those 3 little red bars there? There's the break of all 3 right there. Boom. So he's short on that bar, 4 lots, tight stop right there. That's a stop. Now, he took one off here. Okay. I had some issue with that. Okay. But still, he's heavy in the play, still's got 3 lots. I think that 1 lot came here. Then he's got 2 lots left. He switches to the 8-period moving average. No, I'm sorry, he doesn't. That's another trader. And then he starts going bar by bar. That's what it was. And out here for 2. So he milked this move really, really nicely here. All right. Yeah. Um, the only issue I nitpicked with him about was um, we don't want to take profits on igniting bars here. So this bar is really what ignites you out of the, this is your clearing bar if you look carefully. Like that's the bar that really gets things going. That's the start. You want to take profits like on something like that. See, that bar dropped really nicely away. But you take this bar and put it there in the beginning, and that's getting you started. But he was heavy, so I had less concerns. If he had 2 lots here and took half of it off here, I'd have more of an issue. But because it was 4, it's less of an issue to get down to 3. All right. So yeah, that's a really solid play. Now, if you were to do the whole thing, if you were to do the whole plan I teach you, it would be this. Maybe 1, 2, 3. Here, 1. There, 2. That's 2 lots out. Okay. Now you're gonna move your stop to break even. Let the stock pull back on you. Right there. Add 1 lot there. Okay. Maybe double dip, remember? Add another lot there. Once you drop here, move that stop to the pivot, and there's your whale complete right there. Okay. Does that make sense, guys? Do you see that? You see that? 1 double dip. Boom. So yeah, that was a whale for those who you know. This is a whale on the long side. It's made up of 3 moves. 1, a nice strong initial run. 2 is a reverse move against that strong run, but typically stays in the upper 50% of that run. And then move 3 moves you to a new high, which means you pass the high that was achieved in 1. Okay. So 1, 2, 3, whale complete. On the reverse side, it's 1, 2, 3, whale complete. 1, 2, 3, whale complete. On the long side, it's 1, 2, 3, whale complete. Someone give me a whale complete on the long side. What was a whale complete today on the long side? I think Alina had Oracle today, right? Yeah, Alina had Oracle today. So yeah, here it is. 1, 2, 3, whale complete. So our objective is to grab whales off the open. That is our objective. We want whales off the open. Right? 1, 2, 3. And all whales aren't the same size, right? So some whales are baby whales and some whales are Moby Dick. You know, you got to take what whale the market gives you. Right? AMD. Yeah. What do you want to look at with AMD here, guys? Yeah, I just, for teaching purposes, I just give it a specific name. It's just a new high right after a pullback, right? Yeah, I started calling them whales long after I taught Dan. So you went short, but the double dip failed. Yeah. Uh, no, this is not a double dip, by the way. It's not a double dip. Yeah. First of all, in order to get a double dip, you need a move like this. You see what I'm saying? That's dip one, dip two. Like you need this, the quality of your first move is very important because anything here is not a pullback. Your pullback only counts after you have a run that makes you happy. You need the impressive run first before you start doing pullback analysis. All right. Otherwise, it's just a pause on the way to an impressive move. Like, guys, this is not, let's take it like this. If I go like this, and then I have this, that's not a pullback. That's a pause, or it might be a failure, but it is not a pullback. You don't have enough here. You understand? Uh, you don't have enough to be calling anything a pullback. Okay. So the quality of this is very important to have first. Okay. Another example, if I show you this on the daily chart, this is not a pullback. You see this? This is your clearing bar in the daily. You see how the bigger time frames are easier for you? Here's a clearing bar, very clear. This setback is not a pullback. That's what I call a gift, but that's not a pullback because you didn't have a run like this. Now, the next drop is potentially a pullback because of the quality of that run. All right. So that's very important to understand. All right. Let's go back here. Now, our trader probably went short here, maybe into the second bar. All right. Places the stop there. Okay. It's calling this a pullback. So after the entry bar, you can't have a pullback. It's really not to be considered a pullback because you don't have a really flow like move. All right. Um, but I understand what he's saying. He's saying that look, it tried to drop here, it tried to drop here, there, then it failed. Right. Um, my problem with this is this move. And let's fill that move in. Let's do this. Let's do this. Let's do this. This will make it clear. To me, that bar ruins that move, I would say, ruins the power of this. Now, remember, I told you that if a stock pulls back and stays in the upper 50%, so here's the bottom 50, here's the upper 50 of the move up, right? Now, if your stock stays, that pullback stays in the upper 50, the odds of the next move going to a new high are decent, very decent. But if you get down here, this is the beginning of the move, right? If you get all the way down here, now the travel time and space is much bigger. So the odds of going all the way back to a new high are less, right? Does that make sense? The deeper your drop, the deeper your drop, the less the odds of a new high, right? Same thing on the short side. So let's do this on the short side, right? Same thing on the short side. Check this out. So on the short side, you drop. Now you rally. If you rally there, the odds of a new low are good. But if you rally all the way here, the odds of a new low are not good. So look at this. Look at your drop. And now look at the rally. The rally is all the way here, making the next drop, the odds of a shallower low is higher, right? So the odd, look at the shallower low. And there you go. Does this make sense? Are you picking up what I'm laying down? All right. Nice, yes. Okay. So, nice. Right here, man, I'm like, whew, wow. And if I want to see if this is going to keep going, I'm saying if we break, I'm out. Because I know what that means. We went too high. I got my money back. Maybe this is gonna break, but if it doesn't, I'm out. All right. Yeah. Well, now it shouldn't be. Nice was saying he wanted to take profits there, but that was his gut feeling. I want this to be a knowledge thing now, so not gut, right? So now you know that the odds of a higher low, if you get that drop again, really take advantage of that. You've got luck playing on your side right now. And tighten up, take it or tighten up. You can always even get back in. If it continues to break down, you can always find a GBI here to get back in to the move to the downside. You know? But yeah. So just like I said, look at the move here. Then the pullback stays in the upper half. If you have pullbacks that stay in the top third, those are the best. The only caveat is that something can go too far on the first leg. So guys, look, this is your quintessential move, right? Boom, whale complete, right? But you can't have a move that does this. Now pulls back. Now this pullback is different from this one because it's almost like this move was so big and long that it really is the whale complete. Do you understand? That it moved so far that it just passed number 2. It skipped from 1 to 3, right? It just skipped from 1 to 3. It over jumped 2. So you got to be able to be aware of that too, that your move can be so big that you got your whale already, that the pullback now is troublesome because it's coming from after a whale complete. It's potentially troublesome. Okay. Yes, Cisco. Different. This is a power trend. Power trends take on a different nature, right? So usually the first drop after a power trend is not your troublesome drop. So we're, it's a completely different category. But wow, that's a very steady move with a 5-minute. Look at that clearing on the 5, guys. These clearing bars are amazing. You get oversold, right? So you get oversold. So we were at a high here. So you get oversold. This is troublesome, but you move away from the trouble, right? So you get some distance. Like see how the bounce right after the trouble doesn't work. You see that? But as you get away from the trouble, all right, now the bounce can be real because you are away from the trouble. But the bounce right next to the trouble doesn't work. You guys understand that concept? The bounce right next to trouble is very short-lived, right? That's the dead cat bounce versus the climb. So this is the bounce and this is the climb. There's a difference between a bounce and a climb. All right? Now, one more time. I'll show you this. Second here, guys. I'll be with you just a minute, almost done. All right. So here is another view of Bitcoin. We were looking at the monthly before. Now we're looking at the weekly, right? It's different. This is weekly. So here's your run, right? Late. Remember I told you Bitcoin is a late year runner. Okay, late year. All right. So here's your run. Now here's your drop. But you see, this drop is pretty stark. So you can't expect this to be the bounce, right? It's next to the trouble. The trouble is too close. So you need the move away from the trouble. And if you get that, then this would be the climb. So this is the bounce, and over here would be the climb because you are away from the trouble. All right? Does that make sense? Yeah. Means we could have some time. I mean, it's not impossible for this to do this. It's not impossible to get a, that. It's not impossible, you know? And your climb just starts like that. That's not impossible either. Another thing's not impossible. It's not impossible to do this, what you did here, and have this flash drop below, clean out everybody, and then do your climb. So it's not possible. It's not impossible to have that either. You know what I'm saying? Because that often happens. That's what I tell you gets traders all the time, right? Isn't that this? And I tell you the second one is the big one. Isn't that what I teach you? Yes? Do I teach you this? Don't I teach you that a lot of people get killed there? Right? But what do I teach you about the double dip if it happens? As long as the double dip is where in this move? As long as the double dip occurs where? In the upper 50%. Are you getting this? All right. Awesome. All right. So, we had good lessons about going in close 2 minutes, stepping out far. And it's the same thing, guys. Your ability to see this over and over and over again on the 2 minute chart is priceless. And it's frustrating at times because you see errors more quickly, just like you see concepts play out more frequently. It also means you see mistakes and bad trading more frequently. So it's more challenging, but you do become more skilled through the 2 minute because you become more aware and more experienced through the increased number of trades. And when you do that over and over again for a while, you build that experience up on the 2 minute, I promise you, you will be able to go to any market, any time frame, and play well. Now, let me tell you one more thing. And this is going to be I hope this is very encouraging to some of you. You guys all know that short-term trading is not for everyone. That 92% of all players cannot short-term trade. That is not the statistic for long-term trading. Oh no. I'm talking short-term trading has a 92% failure rate. That's not longer-term trading. So you may not be, it may turn out that you aren't cut out for short-term trading. But if that's you, don't be too discouraged. because everything you've learned here, you'll be able to take to a time frame like this, to a daily, to a weekly, to a monthly, and you're going to kill it there. You may not have been the right short-term player on a 2-minute chart, but that doesn't mean you can't kill the markets on a weekly chart, on a monthly chart, even on a daily chart. So it's not lost. And the biggest money of all happens in the bigger time frames. I got 98% of my wealth in the bigger time frames. Right? So the big money is in the bigger time frames. The trading is in, if you can get yourself on the trading side to a place where you can earn daily more than you need to live, then you can start growing your long-term play side, right? And that's where you want to try to get to, where, you know, you can live off of 10% of what you make every day. Like, people don't, I mean, of course, people who aren't part of us, they don't believe that I buy Bitcoin every day. And they're like, how can someone do that? I mean, from this day, guys, look at this. From this day down here, I bought every single day the whole way. Now you're looking at a weekly chart, but think of daily. Think every one of these bars is 5 days. So every bar I bought 5 times. Every single bar I bought 5 times, 5, 5, 5, 5, 5, 5, the whole way. And I will do this for the foreseeable future. Now, people say, well, how can someone do that? Well, I make on average way more than I need on a daily basis. So I just take the extra that I don't need and I buy Bitcoin with it. No, it's not okay. No. Don't. I mean, I know we do that amongst our families, but don't tell anybody how much Bitcoin you have. Do you realize that we will move to a world where everyone understands that everyone who does well has some Bitcoin? We're going to go to a Bitcoin standard, right? And so it will become very dangerous for people to know how much Bitcoin you have. And you don't want to move there. Right? So yeah, don't get in the habit of telling people. I mean, I show some things because of training purposes amongst my family members, but I've even dropped that off a little bit too. Is by showing everything I'm buying every day to you, you can start to add up, and that's not cool. But so that's the goal, guys, to get yourself to the point of view where you can generate anything that you want. So if you want to start making investments in this, then you start using the extra from your daily trading to do that. You know? But I will say this, that it's far time for us to dematerialize gold. It's old, it's 6,000 years old. It's like floppy disks, right? Like if you saw a floppy disk today, you would be like, what? A floppy disk? What am I going to do with this? If someone gave you an important file on a floppy disk, what would you do with that? Some of you are so young, you don't even know what a floppy disk is. So gold is like a floppy disk, right? And so Bitcoin is the digital version of that floppy disk. Bitcoin is that digital version of gold. And I'll tell you a story. I had about 20% of my wealth in gold. And I can't lie, gold has been kind to me throughout most of my life, actually. Um, and at one particular point, it was a huge play for me back in 2006, 2007, 8, 9, 10. It was huge for me, right? And so I kept 20% in. So I'll show you the month here, guys. Let me show you. Here, right there, when Bitcoin broke, I'm like, you know what? I'm taking all of this out of gold. I'm putting everything here. Now, guys, I don't want to tell you how much this is, but it was huge. This is huge money, right? Guess. So I got all of the documents. This is physical gold now, all right, that I have in 3 different locations, okay, throughout the world. I did all of my documents to liquidate my gold. That's last year. There. Guess when I got it? Just now. Floppy disk, man. That is crazy. Do you understand how much I miss? Now, I'm glad I'm getting it here, because I would have put it in there. But I would have much rather put it in there. It took me this long to get my gold. Old, slow, antiquated. Yes, physical. Not to mention the cost to store it, secure it, security. You understand? Insurance. Like, how antiquated is that? I paid insurance. I paid for security. I paid an annualized storage fee. Do you understand? Like, all of these things ate away at little portions of my holdings. Come on. 6,000 years old. It's had its day. It's Bitcoin's turn now. You know? And so, like, once my eyes were opened up, I'm all in. Guys, don't ever forget this. I love you to death. You're my babies. Goo gaga. Enjoy the rest of your Friday, guys. Enjoy your extended weekend. Remember, there's no trading on Monday. All right? I know some of you non-Americans going to get up on Monday morning and flip up your machines and then send 1,000 messages to my support. My platform's not working. All right. Love you guys. All right. Enjoy your time off. You've enjoyed it. You deserved it. You've earned it. We'll be back at this game. Oh, guys, and if you have any time, right, Saturday, I talk about some of these things we were talking about just to this very day. I mean, today. So I'll be talking about this tomorrow, a little bit more in depth. Tomorrow at 10 a.m. New York time. So if you're around, just join that. It's on my YouTube channels. It's in all 3 languages. All right. All right, guys. So see you tomorrow. Ciao for now. Boom.